Today I'm sharing with you 3 great stocks to buy this month. Each of them come from a great company and have decent dividends near 3%. All of them have pulled away from their recent highs, and the first 2 are from Dividend Kings, and the last one is at its current 52-week low, so you definitely want to watch to the end for that. Let's jump in. And if you're sharing stocks to help you on your investing journey, the first company on our list is in the consumer staples sector. This company is PepsiCo, ticker symbol PEP. And PepsiCo is one of the world's largest food and beverage companies. And just to name a few, it's Pepsi, Mountain Dew, Gatorade, Doritos, Lay's, Ruffles, and also Quaker Oats. Over the last year, PepsiCo has fallen about 3.5%, bringing it to a current share price of $169.12. Due to its recent pullback, it is now around its midpoint of a 52-week range, and PepsiCo is currently trading at a PE of 24.91, has a dividend yield of 2.72%, giving you an annual payout of $4.60. Over on the income statement, looking at its revenue, has been growing its revenue year over year with a slight dip from last year, but it's still above its average for the last couple years. Right down here for its net income, and just like its revenue, it does have a pullback from this last year, but it is above its revenue that it has had the last couple years, with the outlier right here in 2019. For its earnings per share, has had a pullback from last year, but it's still above all of its averages despite this outlier right here in 2019 as well. For shares outstanding, it has been pretty stable the last couple years, around that 1.38 billion shares, which is good to see. They're not diluting investors. As far as the dividends, the values for these last 2 years are incorrect. Actually, last year, PepsiCo has become a dividend king, meaning that it has been increasing its dividend year over year for the last 50 years. Over for its free cash flow, Pepsi has been pretty stable around this $6.3 billion and giving it a 5-year average of $6.22 billion, which is good to see for us dividend investors. Wall Street analysts are considering PepsiCo as the buy right now, with a low of $140 and an average of $187, which is 11% upside. As far as my 10-year analysis, I have a revenue growth of 246%, profit margin of 7%, 9%, and 11%, free cash flow of 6%, 8%, and 10%, and for PE and price to free cash flow, I have 16%, 18%, and 20%, a little higher than I usually go because of the moat that PepsiCo has, and a return of 10%. So with those assumptions, the current share price is above all of these values right here, and just want to point out that the 2 high values right here are around the low price target that the Wall Street analysts have in their last graph we just looked at. Over here on the weekly chart, we can see that PepsiCo has been moving upwards. Even though it has a low, it is above most recent lows, pretty much hugging its 50-day moving average, which is this yellow line right here. Now on a daily chart, this $160 range was a resistance point back in October, as you can see right here, and it only broke through that once it hit earnings. Since then, it's been above all its moving averages until pretty much breaking through them at the start of this year. Now, I wanted to bring up that point around earnings because earnings is coming up again. So even though it has been just staying on that support level of $168 and a negative momentum and oversold area of its trend, it could possibly break through there and rebound again around earnings. But that $168 range has been pretty much as low for the last year. Next company we're going over is in the healthcare sector, focusing on pharmaceuticals. This company is Johnson & Johnson, ticker symbol JNJ. And Johnson & Johnson is one of the world's largest and also diverse healthcare firms. It has different sectors of pharmaceuticals, medical devices, and consumer products, which involves baby care, oral care, beauty, and over-the-counter drugs. Over the last year, Johnson & Johnson has fallen about 4.7%, bringing it to a current share price of $164.61. Johnson & Johnson is starting to move close to their 52-week low, which was $156, and it is currently trading at a PE of 15.66. Has a dividend yield of 2.75%, which will give you an annual payout of $4.52. Over on this income statement, looking at its revenue, Johnson & Johnson has been increasing its revenue year over year, which is great to see. Shown on here for its net income, and just like revenue has been increasing its net income year over year. Earnings per share is looking great as well, continuing to increase year over year. And as far as shares outstanding, it has been staying pretty steady around that 2.63 billion shares. And as far as its dividend growth, it has been growing year over year, as you can see right here. And it is considered a dividend king, growing its dividend for the last 60 years. Looking at its free cash flow, it has pulled back a little bit from the last year, but still around the levels it has had over the last previous years, given the 5-year average of $19.34 billion. Wall Street analysts are considering Johnson & Johnson as buy right now with a low of $164 and an average share price of $180, giving you about a 10% upside. And as far as my 10-year analysis, I have a revenue growth of 2.5%, 3.5%, and 4.5%. For profit margin, I have 15, 17, and 19%. Free cash flow of 17, 19, and 21%. And for PE and price to free cash flow, I have 14, 16, and 18 with a 10% return. And look right here, the current share price is above all of these averages. I want to point out that the high right here is around the Wall Street analyst's low. Over here in the weekly chart, we can see that where Johnson & Johnson is currently around that $164 range has pretty much been its support level the last year, with the highs being around that $180 range being a resistance point. So Johnson & Johnson has been pretty much staying between that range over the last year. Or on the daily chart, we can see that $165 range was a resistance point back in October. So with this negative trend in the oversold area and negative momentum right here, it's going to take a lot of volume to actually push through that $165 range to get back up to its moving averages. Before moving on to our 52-week low stock, let me know how you're enjoying the content by smashing the like button. It helps grow the channel and also spreads the video to other investors such as yourself. While you're down there, consider dropping a comment of your thoughts about these 3 stocks. Next stock on our list is in the healthcare sector. This company is CVS Health Corporation, ticker symbol CVS. And CVS is a retail drugstore with incorporated healthcare services and pharmacy. Over the last year, CVS has fallen just above 21%, bringing it to a current share price of $85.77. As I mentioned, CVS is at its 52-week low and is currently trading at a PE of 9.93. CVS does have a dividend yield of 2.82%, which will give you an annual payout of $2.42. Over on this income statement, looking at its revenue, you can see here that CVS has been growing its revenue year over year, which is great to see. Going on here to its net income, CVS did have a nice bump up the last 2 years and is now coming back to the averages it had prior to 2020. As far as the earnings per share, just like its income statement, it is getting pulled back from its nice bump up the last 2 years. So it's going back to averages it had prior to 2020. And for shares outstandings, it's staying around that 1.32 billion shares. And dividend growth throughout COVID, it was staying around that $2, and now it's starting to grow its dividend once again. Despite the pullback in its profits and earnings per share, it has been increasing its free cash flow for the last 5 years, which is great to see. So we have a 5-year average of $12.3 billion. Wall Street analysts are considering CVS as a buy right now with a low of $92 and an average share price of $115, which is about a 35% upside from the current share price. And as far as my 10-year analysis for CVS, I have revenue growth of 4, 6, and 8%, profit margin of 1, 2, and 3%, free cash flow of 2.5, 3.5, and 4.5%, PE, and price to free cash flow at 14, 16, and 18 with a 12% return. So we're down here looking at these assumptions. Current share price is right in my mid-range. May just be a great time to add CVS to your portfolio if you agree with these assumptions. Looking at a weekly chart, we see that the current low of CVS has been its previous lows, and it was a resistance point in September of 2021. And as far as the highs, pretty much has a resistance point over the $100 range. Looking at a daily chart, we can see that from the end of last year, it's pretty much fallen through all of its moving averages and just staying on the same low it had back last October, where when earnings came, it was able to break through all of its moving averages. So one thing to keep in mind is that earnings is coming up. So we do have negative momentum, and the trend is still in the oversold area, but it's starting to turn upwards in the positive direction. You may just want to keep an eye on CVS, and could be a good trend to buy being at its 52-week low. Those are the 3 stocks I have to consider adding to your portfolio this month. Remember, I'm not a financial advisor, so definitely do your own research before investing in any of these stocks. If you're looking for more stock analysis, definitely check out this video right over here, and I'll catch you over there. Have a blessed day. Peace.